The Bank of England's interventions in September 2022 revealed a financial system more fragile than most observers had acknowledged. At that time, an unprecedented combination of ultra-low interest rates, high government borrowing, and structural leverage within pension funds created a perfect storm. The so-called gilt crisis was not the result of a single failing institution. Rather, it was a systemic misalignment between public debt markets and private financial practices. Long-term liability-driven investment, LDI, strategies, widely adopted by pension schemes, relied on hedging future obligations using derivatives and leverage positions in government bonds. When the UK government's mini-budget triggered a sharp spike in gilt yields, pension funds were forced to liquidate vast quantities of bonds to meet margin calls, prompting a rapid feedback loop. Bond prices fell further, forcing even more sales. The Bank of England's emergency purchases of government bonds stabilized the market, but the episode highlighted a critical lesson. Leverage, whether in regulated banks or pension funds, can amplify shocks beyond traditional buffers. Fast forward to present, and the structural vulnerabilities have not only persisted but intensified. Private credit, non-bank lending largely outside the scope of conventional regulation, has expanded dramatically. According to Bank of England and the Financial Stability Board, global private credit assets now exceed $1.7 trillion, with the UK representing a significant, though opaque, share of this growth. Unlike traditional bank lending, private credit funds are free to operate with flexible covenants, rely on self-reported valuations, and often employ high leverage. Many borrowers in this market are companies that would struggle to access traditional bank finance due to weaker balance sheets or marginal cash flows. These firms increasingly rely on the assumption that interest rates will decline over time and refinancing will always be possible. The fragility of this assumption becomes clear when macroeconomic conditions shift unexpectedly, as they did in 2022 and again during the recent global tightening cycle. A particularly concerning feature of this market is the proliferation of payment-in-kind (PIK) loans. These instruments allow borrowers to defer cash interest payments by rolling them into additional debt. On paper, this may preserve liquidity for struggling companies, but it masks the absence of real cash flows and artificially inflates balance sheets. The illusion of financial stability can persist for months or even years, only to vanish suddenly when the underlying borrower cannot refinance or service the accumulated debt. This creates a hidden tail risk. A cluster of PIK loans defaulting simultaneously could force rapid deleveraging across multiple investors. Pension funds, insurers, and retail investors, many of whom are exposed indirectly through funds or structured products, could experience sudden mark-to-market losses with little warning. Pricing opacity in private credit compounds a problem. Unlike publicly traded securities, private loans are rarely subject to independent market valuation. Instead, lenders and fund managers often set valuations themselves, creating potential for significant mismatches between reported value and realizable value in a stress scenario. Historical examples show that loans can be marked at full value shortly before borrowers default, revealing that risk was effectively hidden until the moment of collapse. This misalignment between perceived and actual risk introduces second-order effects. Investors may increase exposure based on misleading signals, leverage further, or underprice risk in their own portfolios, creating a reinforcing cycle of vulnerability. Interconnections across the broader financial system magnify these dangers. Hedge funds, banks, insurers, pension funds, and shadow banking vehicles are increasingly linked through complex chains of borrowing and lending. A shock in one segment, whether rising bond yields, falling equities, or the failure of a leveraged private credit borrower, can cascade rapidly, forcing asset sales across multiple markets simultaneously. The 2008 financial crisis illustrated how hidden correlations and untested assumptions could transform localized stress into systemic instability. In today's context, the combination of high leverage, opaque valuations, and interlinked institutions raises the probability of a similar cascade. Even regulatory stress tests, which often reassure markets, are limited in their predictive power. Banks may pass hypothetical stress scenarios under the assumption that non-bank sectors remain stable. Yet the Bank of England has acknowledged that it cannot fully map the transmission of shocks through the shadow banking system. This introduces a structural blind spot. Regulated banks may appear resilient on paper, while the broader financial ecosystem harbors vulnerabilities capable of precipitating rapid, widespread losses. The potential for simultaneous shocks, credit, liquidity, and market, creates a scenario in which conventional buffers, such as capital ratios or liquidity coverage ratios, may prove insufficient. The distributional implications of such fragility are also significant. Ordinary savers and pensioners bear the immediate consequences of financial disruptions, even if the institutions of the epicenter are sophisticated or nominally well-capitalized. Falling asset values reduce retirement savings, undermine confidence in investment products, and in extreme cases, contribute to wider macroeconomic contraction as households cut consumption. Conversely, the institutions driving these risks, private credit funds and highly leveraged hedge funds, often have mechanisms to shield themselves from immediate losses, creating a feedback loop in which systemic risk is socialized while profits remain private. What becomes clear is that the UK financial system is operating in a zone of heightened vulnerability, structurally different but conceptually reminiscent of 2022. Leverage has returned, but this time it is embedded in less regulated, more opaque sectors. The incentives driving borrowing, lending, and risk allocation have not fundamentally changed. Rather, they have shifted toward instruments and institutions that mask true exposure while amplifying systemic sensitivity. The consequence is a financial environment in which seemingly minor shocks, a rise in bond yields, a slowdown in corporate earnings, or a funding hiccup in private credit, could reverberate across the entire system, triggering rapid repricing and forced deleveraging. The narrative thus moves inexorably from a memory of the gilt crisis to the emerging risks in private credit. Understanding these mechanisms is not an exercise in alarmism. It is an acknowledgement that structural vulnerabilities, once exposed, propagate through complex feedback loops with consequences for ordinary investors and the economy at large. The lessons of 2022 remain relevant. Liquidity is fragile, leverage is persistent, and the apparent stability of markets may conceal deep, systemic stress waiting to be realized. The fragility of the UK financial system extends beyond the private credit market, permeating the complex web of interconnections that bind banks, pension funds, insurers, and hedge funds. While each sector may appear insulated in isolation, their interactions create feedback loops that can magnify localized shocks into systemic crises. In practice, a stress event in one segment often propagates through multiple channels. Margin calls of hedge funds can force asset sales at depressed market prices, triggering losses at pension funds and insurers whose portfolios are marked to market. These losses then prompt further deleveraging, creating what regulators describe as a fire sale dynamic. The lessons of 2008 and of the 2022 gilt market turmoil illustrate that these loops are both rapid and nonlinear, meaning small perturbations can produce outsized systemic consequences. Consider the interaction between pension funds and the private credit sector. Defined benefit DB, pension schemes in the UK are heavily invested in assets designed to match long-term liabilities. Liability-driven investment, LDI, strategies often involve holding gilts or derivatives with leverage to hedge against interest rate risk. When interest rates rise or asset valuations fall, the scheme faces margin calls that must be met through rapid liquidation. In 2022, this forced the Bank of England to intervene with emergency gilt purchases. Today, many DB schemes have exposure to private credit either directly or indirectly through multi-asset funds. If leveraged borrowers in private credit default or valuations are suddenly marked down, pension schemes may confront simultaneous liquidity pressures from both public and private markets, compounding the risk of forced sales and wider financial instability. Hedge funds, too, act as amplifiers rather than buffers in this system. Their strategies often involve high leverage, derivative positions, and short-term funding structures. While these funds are sophisticated and capable of profiting from volatility, they are also highly sensitive to rapid market movements. Should a cluster of private credit defaults or a sudden spike in government bond yields occur, hedge funds may unwind positions simultaneously, placing further pressure on asset prices. The resultant stress can spill over into broader financial markets, affecting institutions that are neither hedge funds nor directly exposed to private credit. This interconnectedness highlights a critical structural constraint. Systemic risk is not merely the sum of individual exposures, but function the relationships between actors and the speed, with which stress propagates. Insurance companies, traditionally seen as conservative, are increasingly entangled in this web. Many insurers invest heavily in corporate debt and private credit to meet yield targets in a low-interest environment. Unlike banks, insurers are not subject to the same liquidity requirements, and they often rely on actuarial assumptions about default rates and recoveries. In a rapidly deteriorating private credit market, these assumptions can prove misleading. A series of PIK loan defaults, for instance, could reduce cash flows and capital ratios faster than insurers can react, forcing them to sell other assets and triggering a chain reaction through equities, bonds, and derivative markets. The structural implication is clear. Interconnected leverage across asset classes and institutions creates channels through which a stress event in one domain spreads to others with unexpected intensity. Regulatory oversight, while more robust than in 2008, faces inherent limitations. Stress tests conducted by the Bank of England focus primarily on banks and, to a lesser extent, insurers. These scenarios assume that non-bank financial institutions, including private credit funds and hedge funds, continue to function normally. The reality, however, is that the non-bank sector now constitutes a significant portion of credit intermediation. Its opacity, reliance on self-reported valuations, and limited regulatory oversight mean that shocks in this sector may unfold undetected until they reach critical mass. Policymakers have acknowledged that they cannot fully map how stress would spread through these channels, creating an asymmetric risk profile. The more sophisticated and interconnected the system, the harder it is to anticipate the timing and magnitude of a crisis. Beyond institutional risk, the distributional consequences of such systemic stress are profound. Ordinary savers, pensioners, and households bear the brunt of losses, even when the crisis originates in complex, ostensibly high-level financial transactions. Declines in asset prices reduce retirement savings, while credit market tightening can curtail corporate investment and job creation. In the medium term, this translates into slower wage growth, diminished employment opportunities, and increased economic uncertainty. Meanwhile, highly leveraged institutions that initially benefit from rising yields or accommodative market conditions may protect themselves through risk management strategies, leaving ordinary investors exposed to downstream consequences. In effect, systemic fragility redistributes risk from sophisticated actors to the wider population, amplifying inequality and economic vulnerability. Scenario analysis underscores the potential pathways for such a crisis. A sudden increase in gilt yields, similar to 2022, could trigger margin calls at DB pension schemes, while simultaneously destabilizing leveraged private credit borrowers. Hedge funds, facing losses, may rapidly unwind derivative positions, depressing asset prices further. Insurers and multi-asset funds, dependent on mark-to-market valuations, may react by selling other holdings, creating additional downward pressure. The resulting feedback loop could produce a liquidity squeeze across multiple markets simultaneously. Even a relatively small initial shock, if it occurs at a time of low market liquidity or widespread leverage, could cascade into a broader systemic event. Importantly, the timing, intensity, and duration of such a scenario remain inherently uncertain. What is predictable is a mechanism by which stress propagates, and the sectors most vulnerable to second-order effects. Policy responses face structural constraints as well. Emergency interventions, like the Bank of England's 2022 gilt purchases, can stabilize specific markets in the short term, but cannot address the underlying fragility embedded in leverage, opacity, and interconnectedness. Measures such as enhanced disclosure, liquidity requirements, or stress testing may mitigate some risk, but they cannot fully eliminate the possibility of rapid deleveraging across non-bank sectors. The persistent expansion of private credit, coupled with PIK loans and self-valued assets, suggests that systemic vulnerabilities will continue to grow unless regulatory frameworks evolve to capture these non-traditional channels of risk more effectively. After examining the evidence, what becomes clear is that the UK financial system is navigating a landscape of heightened interconnected fragility. Leverage has migrated into opaque sectors, creating potential for rapid propagation of stress across institutions and markets. Ordinary households, through pensions and savings, remain exposed to these hidden vulnerabilities. The combination of complex feedback loops, valuation opacity, and structural interdependence suggests that even modest shocks can produce disproportionate outcomes, echoing lessons from 2008 and 2022. Recognizing these mechanisms does not predict the precise timing of a crisis, but highlights why vigilance, transparency, and structural reform are essential to mitigating systemic risk.